Alrighty, welcome everybody. This is Institutional Trading Strategies. Today we're going to cover FX options. We've had lots of requests for this webinar, and it's my pleasure to be able to bring it to you. I'm your host, Andrei Knight, and options definitely are an institutional trading strategy, you guys. This is a long-kept secret. It's been used for a long time in both stocks and commodities, and it's becoming increasingly popular in forex. Because have you noticed, the banks never tend to lose. Whichever way price moves, they find a way to make money. And that's what I want to teach you how to do today. All right? Before we get started, you guys, a couple of disclaimers. The regulators make us do this. Okay? First of all, a risk warning. Forex trading carries a high level of risk to your capital with the possibility of losing more than your initial investment. Check your broker's policies. These products may not be suitable for all investors and are only intended for people over 18. Please ensure that you're fully aware of the risks involved and, if necessary, seek independent financial advice. I also want to let you know that today's presentation is for educational purposes only. The content of this webinar is the personal opinion of the moderator, that's me, and not fxstreet.com. The content does not constitute financial, investment, or tax advice. You are advised to discuss your specific requirements with an independent financial advisor prior to entering into any trade. fxstreet.com is not responsible for and disclaims any and all liability for the content or comments during this session. All right, in case you're not familiar with me, let me tell you a little bit about who your presenter is today. It helps to know your information is coming from a credible source, right? There's a picture so you can see who's at the other end talking at you. I am the founder and chief strategist at fxknight.com. If you haven't been there yet, I encourage you to stop by sometime and visit. The reason this website was born is I noticed that I tended to start my trading day by visiting half a dozen to a dozen different websites to get all the information I needed. And I started thinking, well, why can't one website have all this information in one place? So that's kind of what FX Knight grew out of. You'll find news you can read, you'll find news you can listen to, you'll find training videos and webinars you can watch, you'll find a live chat room, forum, all sorts of goodies. I'm a regular contributor to FX Street, which is a wonderful website. Okay, start your research there. I also happen to write for Daily FX, Forex Pros, Baby Pips, and the International Business Times. But like I said, FX Street, by far my favorite. I'm the author of Forex Trading for a Living, and the book started out pretty much the same way as the website. When my students would ask me to recommend a good trading book, I found myself recommending a couple, because I couldn't think of just one that had all the information they needed. Some books would be really good in some parts and really weak in others. So I set out to write up my own. And most important, you guys, I'm a professional analyst and fund manager. I'm in the markets every single day, just like you. I'm not teaching you theory. I'm teaching you techniques that I use myself. Okay, I'm a trader first and a teacher second. Here's a partial list of the clients and the companies I work with, right? You don't have to memorize it. If you want to look it up, it's on our website. There's an About tab in the upper right-hand corner. But just to give you an idea, I am a credible source. And in recent years, I've become a speaker and a coach because, as I mentioned, lots of traders come to me after losing their money and ask for advice. And I thought, well, gee, wouldn't it be nice to reach traders before they lose their money? My paid classes, if you choose to take any, cost much less than the typical losing trade. All right, you guys, so let's begin our discussion by identifying what is an option. What do we mean when we say options? An option, very simply, is a contract that you purchase, and unlike currency pairs where you can go long or short, buy or sell, options are a contract. You can only buy them. Unless you're really wealthy and you happen to be an institution writing options, then you sell them to somebody. But as a trader, you will generally be buying options. Depending on whether it's long or short, there are different kinds of options. And we'll get into it. Okay, but you are always buying a contract, and what that contract gives you is the right, but not an obligation, to purchase a security at a later date at a certain price, and we call that the strike price. Okay? So you are buying a contract that entitles you, but you don't have to act on it. You can let it expire, doing nothing, and then all you lose is the cost of the contract itself, which is usually a couple bucks depending on the broker. Okay, you don't have to act on it, but should you so choose, you have the option, hence the name, to execute that contract at a certain price level. Pretty simple, nothing complicated. A lot of people start to get really weirded out when you get into options, but it's not that difficult a concept. Before I describe the different kinds of options contracts, you guys, let's talk a little bit about why you should buy options. Okay? Primarily, they're your insurance policy. That's why we buy options, you guys. Okay? Why do you need insurance? Well, in case something bad happens. Right? That's why people carry insurance coverage. Same thing in trading. When something bad and unexpected happens, your insurance throws you a life raft and saves you from a potentially bad situation. That is the correct way to use options. There's also an incorrect way to use options. When do you not want to use options? What's an incorrect way to use them? Well, for speculation, which is unfortunately the way the majority of people use options. Okay? I've heard it always said that options are a much cheaper way to trade because all you pay is the price of the options contract, and if you're wrong and it's a losing trade, you don't lose the entire amount of the loss, you only lose the cost of the options contract itself. That's a flawed argument, in my opinion. If you lose the price of the options contract, you are losing 100% of your investment, right? The entire price you paid for the contract. Any investment where you can lose 100%, in my book, is a risky investment and should be avoided. Realize also, if you're trading options for pure profit, for pure speculation, you have to get not one, but 3 factors correct. Okay? If you're just buying or selling the underlying currency pair or the underlying security, all you have to get right is the direction. If it moves in the direction you expect, you get to cash out for a profit. With options, you have to get 3 things correctly. So you are 3 times more likely to get it wrong. With an options contract, in order for it to be profitable, if you're buying it for speculation, you have to get the direction right, you also have to get the strike price right, and you have to get the time right. Okay? If any one of those 3 factors is wrong, your options contract expires worthless, and you've just lost 100% of your investment, whatever it costs you to buy that contract. In other words, you are tripling your chances of failure. Price may well go in the direction you expect, and it may well stop at the price you expected. But if your options contract is for a month, and it takes 2 months to get there, your options contract will expire before you have a chance to exercise it. Okay? Don't forget, talking purely speculation, it's a much riskier investment because you have to get 3 factors right and not just the direction by itself. Okay? When you're buying options, there are 2 basic types you can buy. Let's get a little bit of the terminology down that's unique to options themselves. First of all, there's what's called a call. And as you can see by the picture, a call is basically what you would normally buy if you think the price will go up. Okay? Just like the man's megaphone is aiming up in the picture. Okay? A call is a specific kind of contract that lets you execute the trade at a higher price. So naturally, you would want to exercise that option if price moves up. Okay? Call up. The opposite of a call is called a put. And for this, I use the example of putting something down on the ground. Okay? In other words, you would buy a put. You're still buying a contract, but you buy a put if you expect the price to go down because you're going to exercise the contract at a lower price than what you bought it at. Okay? Call up, put down. See, it's not that complicated. Anybody confused yet? Or are we all on the same page? Buy a call if you think price will go up. Put it down if you think price will go down. And just so you know, a put is not the same thing as a put. Okay? A lot of traders also play golf, but we're talking puts, not putts. So what is the correct way to use options? We talked about the incorrect way to use options. And Ritesh, you said you've traded stock options before forex trading. Did you trade them for speculation or for insurance? Just curious. Speculation. Yeah, that's the risky way to do it, my friend. You have to get 3 times more things right, and if you screw up any one of those 3, you risk 100% of your investment. A lot of institutions that use options for stocks use them for insurance. And you can do exactly the same thing with forex trading. You can combine what you know from both worlds, forex and options, but let me show you how to use them for insurance instead of speculation. Okay? You'll recall our prior example. We buy calls when we think the price is going to go up. Okay? Well, those of you that have known me for some time, you know that I'm a contrarian. I like to do things differently. So for insurance purposes, we're going to buy a call if we think price is going to go down. The opposite of the picture. Now you might be scratching your head going, what the heck? I thought you just said buy calls when you think price is going to go up. For speculation, yes. For insurance, you do the opposite. If you think price is going to go up, if you think price is going to go down, you buy a call. The exact opposite. And let me show you why. Let me show you how this works. You're going to love it. Okay? Let's say price has been chopping for a little while in a range. You're not quite sure what it's going to do next. And suddenly price makes a sharp down move and breaks out of the prior range. Okay? This would cause you to believe that price is going to go down. Right? It broke the prior range, made a lower low. If you think price is going to go down, you open a short trade. Right? You sell. But at the same time, for insurance purposes, you'll simultaneously buy a call, which is a bet that price will go up. Let me show you how this plays out. Assuming you went short and price does continue moving down, well, you're a happy person. Because the short trade you took in spot FX is now in profit. And you just made money. What about the call option that you bought? Right? That was a bet that price would go up. And that contract expires useless because price never went up. It went down. But the cost of an options contract is a few bucks. Meanwhile, hopefully you made much more than that in profit on your short trade. So in other words, you bought an insurance policy. You didn't have to use it. Thank goodness. Right? Insurance is never free, but you're glad you have it when you need it. Okay, so you lose the money on the options contract, which is usually a few bucks, but you've made much more of that in profit on your real trade. Now, let's take a look and see what would have happened if price went the other way. It broke out of the bottom, but we didn't wait for a retest, or for whatever reason a new piece of news comes out, price does the exact opposite of what we would have expected, and it goes up. Well, in that situation, your short trade is in the negative, right? You expected price to come down here. Your short trade is now losing money. But you have an option that you can exercise when price gets up here, and that option is in profit. Now you start to see why the banks never lose. They've got their butts covered. Either way, they're going to make a profit. If the trade does what they expect, they make a profit on the spot trade. If the trade does what they didn't expect, the money they make on their option brings their loss to break even. And that is the value of an insurance policy. You guys starting to see the wisdom of this? We're not saying drop what you've been doing in forex and switch to options. We're saying add options as an insurance policy on your forex trade in case they go wrong. Okay, now obviously if you're a scalper on the 1 minute, 5 minute chart, this will be of limited use to you, because the cost of the options contracts added with your spread on the spot trade is usually going to make this not very worthwhile. But I try to discourage people from scalping and short-term trading anyway. It's a great way to lose. There's lots of noise in the markets. But if you're taking longer-term trades, adding FX options to your repertoire is very quickly going to become one of your best friends. Oh, you use stops as well, Boyke, because you don't want the losing trade to go too far in the opposite direction, and your stop should never be wider than your option is. Usually your stop will be much tighter, and that's why the option can often earn you more money than the losing trade loses, because it's probably not going to go all the way up here. Your stop would probably be triggered outside and above the range. Meanwhile, your profitable option goes all the way up to here. Okay? So oftentimes, your option will bring you more profit than you lose on the trade if you use stops. It's about using these things in combination. All right, now let's take a look at an example with a put and how that would work. Okay? If you'll recall, I said buy puts. If you're a speculator, you normally buy a put if you think the price will go down. Well, me being the contrarian, I don't like that rule. We're using options as insurance, not as speculation. So we're going to buy a put if all our analysis leads us to believe that price is going to go up. Then you buy a put. We do it the opposite way. Okay? Here's our price bouncing in its range again. Oops, we just made a higher high. This leads me to believe price might go higher. So I'm going to open a long trade, I'm going to buy the currency pair, and simultaneously I'm going to buy a put as an insurance, as a bet that it'll go down. Remember, you don't have to exercise the contract. You have an option whether to exercise the contract or not. Well, let's see what would happen, how this plays out. Okay? If price goes up and you bought long, you're celebrating because your long trade is in profit. Meanwhile, your option contract down here expires worthless. But again, the option contract costs you a couple bucks. Hopefully in profit, you've made much more than that. Insurance is never free if you want it. Okay? Let's look and see what happens when the unexpected happens. We break to the top side of the range, and suddenly there's a sudden downside reversal. Price does the complete opposite of what we expected. Okay? Well, now the long trade is in the negative. It's losing money. However, you've got the option to exercise your put at a lower price. So that would lead to profit. Worst case scenario, break even. But if you combine this with stops, perhaps right below the bottom of the range, the option has more profit than you lost on the losing long trade if price goes down. In other words, this is a true hedge in its truest form. A lot of people toss the term hedging around without really understanding what it means. Everybody understand the long and short of this? Whatever trade you're taking, you take out an option in the opposite direction. The theory being either your trade or the option will be profitable, but you will never have two losers. That's what makes it a hedge. You buy the option in the opposite direction of the actual spot trade. Let me talk a little bit about true hedging and what it means. Going long on the Euro USD and going short on the dollar yen is not hedging. Those pairs are not guaranteed to always move in opposite directions. The thing about two-way correlations is they work until they break down. But they never warn you ahead of time when they're going to break down. The shops that I know that have systems based on correlation trading usually have a team of full-time analysts whose job it is to measure the correlation almost every single hour. It's not a fixed point. Correlations are always changing. I've seen the dollar-yen and the EU move in the same direction, which usually makes for a great trade on the euro-yen, by the way. So that is not a hedge, you guys. That is doubling down. I'd much rather you just opened a second lot on the EU and left it at that if you're feeling twice as certain. Okay? That is not hedging. It is doubling down. Going both long and short on the same pair at the same time. This is very often how a lot of people define hedging. I think it is just plain stupid. So now you're paying your broker twice the spread. And you might end up with two losing trades. That's not hedging. Hedging is protecting yourself from unexpected market movements, not exposing yourself to them twice as heavily. Okay? Neither of those is true hedging, you guys. The purest and truest way I know of to hedge is to go long and simultaneously buy a put. That is hedging. Or going short and simultaneously buying a call. Always in the opposite direction. That is true hedging. Okay? If you're going to take a screenshot of only one screen in this entire presentation, this is the one. When you go long, if you want insurance, buy a put option. When you're going short, if you want insurance, buy a call option. Always the opposite. The idea being, if you lose money on the trade, you make money on the option. If you make money on the trade, you don't need the option and you can let it expire worthless. The best form of insurance is one you never use. Alright, so what if you want to trade FX options, you guys? Well, one broker that we've worked with for a while, I'm happy to announce, now offers them. FXDD. They have offices in New York for all you American traders, and they have offices in Malta for all you international traders. Okay, you can pick the one appropriate to you. What I really love about FXDD, besides the fact that we've had a relationship with them spanning several years, and we have yet to have anybody complain about them, they have MetaTrader. So you don't have to switch platforms. You can use the platform you're already familiar with. You can trade standard, mini, and micro lots all from the same account. And they just started offering FX options, which makes it even sweeter. If you guys want to find out more about FX Pro, go to our website, fxknight.com, and you'll see them on the left-hand sidebar. You'll see a little button. Pardon me, FXDD. Okay? If you want to find out more about them, just find their button on our sidebar. That is not paid advertising space. We only recommend brokers whom we or our other traders use themselves. It's not a paid advertising spot. Okay? And you can download a demo. You can play with it. There's a link there to open an account. As a special bonus, for any of you that do short-term trading, they offer eSignal and Acuity Workstation for free. And Acuity is about the best scalping platform I've ever seen. Now, you don't necessarily have to use just this broker. Saxo Bank offers FX options now. And this is just a guess, you guys, but I have a feeling all the other brokers are going to start jumping on this bandwagon. Because as you can imagine, having a situation where you cannot lose is popular with traders. So if your broker doesn't offer it, ask them, suggest them. There's a good chance they will in the months ahead. I expect more and more brokers will start to offer FX options as they continue to gain in popularity. Like I said, the stock and commodities worlds have known about this for years and have used this for years. But for insurance, those who do it speculatively usually don't win very much. It's a very rare thing when you get all three right. Direction, price, and time. Ramon, if you're in the UK, you could go with their Malta office. I don't recommend using the US office unless you live in the US. Not that I've got anything against the US office, but the US certainly has far stricter trading regulations. Right? 50-to-1 leverage. They don't let you open up long and shorts in the same pair at the same time. Not that I think you would want to. But, they've started passing all these new restrictions on how you can and cannot trade. First in, first out. By law, if you live in America, you have to use an American broker. So that's why they have a New York office. But if you don't live in America, I would recommend their Malta office because you're not bound by all these new regulations. All right, you guys, couple tips for going further. I can't claim to teach you everything you need to know about trading in a single webinar. There's lots of things you need to know in order to trade effectively. The cool thing is FX Street has been kind enough to record a lot of my prior webinars. Okay, so if you visit this link that I just posted, you will be able to, and if you don't see the link, by the way, in the recording, you can just go to fxknight.com and then click on the Trading Academy button in the main menu. It'll take you to the same place. Okay, you'll find lots of webinars that FX Street has been kind enough to record for us. They'll tell you all about how to find entry and in different market conditions, trending, ranging, reversing. You'll find a webinar on how to place stops, how to trail them. You'll find a webinar on how to spot reversals and maybe get out of your trade earlier. You'll find webinars on which indicators to use to confirm your entries, depending on the type of entry. There's a webinar on money management and position sizing. So whatever topic you need to brush up on, you will find an FX Street webinar that should answer that question. And if not, let us know. We'll record more as time goes on. Thank you, Mod. Or if you're on the FX Street website, click on webinars and then speakers. It's Andrei Knight, right? You will find it there. When you're done with everything FX Street has to offer, though I do recommend you come back to this website. It's an excellent website for news, you guys, and for training. Come visit us at fxknight.com. If you found today useful, imagine what would happen if we started and finished each trading session together each and every trading day. Doing an overview in the morning and a wrap-up in the evening, a critique of your trades. And you could watch other people getting their trades critiqued. It will multiply your profits many times over, and it will speed you on your goal to consistent trading much faster. That's why we keep winning awards. But my goal today is not to sell you guys something. It's an option if you want to go further faster. As I mentioned at the start, fxknight.com has lots of free resources for traders as well. We offer free webinars and training videos. It's got a live chat room, trader forums that are indexed by keywords so you can find the topic that's of interest to you. It's keyword searchable. We recently just added a news squawk service. You can listen to the news in real time, you guys, as it breaks. You could pay thousands and thousands of dollars every single month for the Bloomberg Professional Terminal. But you know what? There's times when the Reuters 3000 terminal beats Bloomberg by a few seconds. Well, you could spend thousands and thousands of dollars for Reuters 3000, but what when Bloomberg beats it? You see what I mean? The only way to really win is to have both. Now you're out about 10 grand a month. Our news provider has both, plus about 24 other news sources that they constantly monitor. So whoever breaks the news first, you will hear it first, regardless of where it actually comes out first. In real time. And it's free. That's the best part about it. It's completely free. And when there is no news to report, it shuts up. It's not like Bloomberg or CNBC that's always making noise in the background. It just squawks in when there's an important piece of news to report. And then it's quiet the rest of the time. And when there's important scheduled news announcements, we actually count down to it. We'll tell you 10 seconds till news, 5 seconds till news. You guys are going to love it. We spent a long time trying to get this set up for you. If you're more of a visual person as opposed to an audio person, we've got streaming forex TV as well. And I encourage you guys to sign up for our newsletter. All of this stuff is free. We're not going to spam you. We're not going to try to sell you lots of stuff. If we have a discount on our pro training or a sale, we'll certainly let you know about it. But generally, the focus of the newsletter is to let you know about tools that can help your trading. And those of you guys that love Twitter, our address is at Black Knight FX. I do send out tweets, not a bunch of them, but a couple a week. I'm not going to clog your inbox. But if I spot a key level or a reversal somewhere, I'll generally set out a tweet to let you know. And if you know Twitter, you know you can also have your tweets arrive as a text message on your phone when you're traveling. So whatever your preferred mode of communication is, get in touch. Don't let today be the end. Let it be the beginning. If you do go to our website, let me just show you where to find some of the things I covered. Okay, News Radio. That's the button you click on to activate the squawk service. And once you've activated it, you can also detach it from your browser. And then you can minimize your browser and free up that space for trading. All the webinars I've been talking about, you'll find them by clicking on Trading Academy over here. And also, while you're there, check out our free stuff section. We've assembled a bunch of what we think are really useful software tools to help you with your trading. All right, you guys. And that's it. Options do not have to be complicated. It's a very simple way, particularly on your longer term trades, to buy an insurance policy in case things don't quite go the way you expected. That's all there is to it. It doesn't have to be complicated in order to be effective. Any questions out there, you guys? Got a couple minutes left to take any questions if you have them. And if not, that's okay too. It's not a particularly difficult concept. I don't write options, no, Ritesh. I primarily spot trade, but like I said, for my longer term trades, I'll take an option in the opposite direction. Writing options is a very risky business, and you usually need a lot of risk capital in order to be able to do it effectively. That's something that's usually best left to institutions. It depends on your trade, Chelsea. Depends where your stop and your target is on your spot trade, and also how many lots you're using. You want to calculate it so that the options contract, if the trade goes wrong, the options contract will at least bring you to break even, assuming your stop gets hit, or preferably even give you some profit over and above that. So you got to figure out where your stop is first. The stop in your account balance, your account size, will determine how many lots you get to use, and the combination of those will tell you what size or how many options contracts to buy. That's the order I would do it. Stops first, then position size on the spot trade, and then figure out how many options contracts you need to break even, or even better, make a profit. There's nothing better than making a profit when things go wrong. Well, about the only thing that's better is just, the trade going straight to your target. All right, you guys, and with that, we'll wrap it up for today. Thank you very much for your time and attention. Hopefully I've given you a few cool ideas that you can add to your trading repertoire. As with everything else, don't drop what you're doing and do this instead. Add this to your toolbox.